Hey guys, welcome back to Two Guys Talking Houses. Today we are talking mortgage rates. They're coming down a little bit. So Mark, let's get right into it. You know, the federal funds rate was not dropped at the last Fed meeting, which was the topic of our last discussion.
Right.
But rates are coming down. So what's going on here?
Well, it's because everybody in the market is absolutely insane. That's really the reason. Or maybe not. No. So there's so many different factors that go into this. And, you look back in October, last October, we had better interest rates on mortgages. I mean, FHA was down to like 5.6 on average, right?
Yeah.
Yet the federal funds rate was what, 5?
Something like that.
Yeah, it's 5.5. And that was when they did the half point drop. And so there was a lot of interest at that point, like, oh, this is looking great, right? And that is basically what's moving the markets. It's not necessarily, and it's not a direct correlation, as we've said many times before, right? The federal funds rate does not dictate the mortgage rate. So you have a lot of other factors like what does Chairman Powell say after they announce what the Fed did at that Fed meeting?
Right.
And what happens the day after with the labor statistics of, they're so far off. There was a huge adjustment, then people are thinking, well, maybe if Powell had that information the day before, a couple days before, when the Fed meeting was going on, that would have been different.
Well, that also, we talked about how that substantially increased the likelihood of a rate drop for the next meeting when those numbers were revised. So I'm wondering how much of this mortgage rate drop is really built, like priced in anticipation of a rate drop in September.
Yeah, it's often not what has happened, it's what people think is going to happen.
Yeah.
And that's kind of what's going on. Is, they're looking at it, and if you think about it, if you're a mortgage company, right, and you've got, your cost of funds to deal with, you've got interest rates to deal with, how much are you able to make on, each loan or each pool of loans, and that margin, needs to be adjusted depending on the market. You want to attract more customers, you got lower rates, but what if those rates shoot back up all of a sudden?
Yeah.
And so now your cost of funds is going up, and you're still, you got the loan that now you might be losing money on. You don't want to lower those rates too quick, just in case something like that happens and moves the other direction. And so now hearing the Fed say, like, hey, you know what? Yeah, September is probably a time. Here, seeing two people dissent, from Powell's. Okay, that's having the Fed chairman speech or Fed president speeches afterwards, where they're saying, basically, hey, we're all for it. Having labor and all of that builds up to lower interest rates. Now, we're not at 5.625 in FHA, but we're certainly seeing 5.875, 6%. It depends. Now, you can always go find that 4% rate with 17 discount points or whatever it is, but if you're truly just looking at raw rates with no buy down, no temporary buy down, none of that, then it's right about 6% on FHA.
And we talk about 5% being the magic sweet spot on the show a lot. Any rate with a 5 in front of it, even if it's 5.99, seems to get the market going a little bit. People feel like, okay, rates are back in the 5s. I'm going to get back in the market. I'm going to start buying. And what I'm seeing, from the realtor side of this thing is more and more people starting to list. That's kind of the one thing that nobody's talking about is, yes, we need rates to come down for, buyers to reenter the market, but we kind of also need home prices to come down just a little bit as well. And we've seen that because of the inventory surplus that's happened. Like Texas, we're kind of somewhere in the middle, but I think it was Seattle, if I remember correctly, looking at my numbers, that's like 28% up on their listings right now, year over year. And so they're seeing a lot of increased homes on the market, which is obviously giving a lot more consumer choice to the buyers. That on top of the fact that they can get a rate in the 5s, now you're starting to see some movement, and you're starting to see, the sellers get a little bit more competitive, which, if we're being honest here, sellers haven't really felt the need to be competitive since COVID. And now they're like, okay, well, we're one of 100 on the block. And, if we want to move this house, we got to get competitive. And it's one thing to just say, I'm going to hold my house until rates come down, or I'm going to hold my house until the prices go back up. But we know that death, divorce, family differences, jobs, whatever it is that cause you to need to move, those things, you can only wait so long for those types of things. And I think that's why we're seeing this inventory shoot right back up.
And there's another factor, and we've kind of laughed about this before, but if you think like we had a season where everybody was encouraged not to go anywhere and to be in the same place for days or weeks on end. And now they've got a 5-year-old.
Yeah.
Just it happens, right?
Yeah.
And so now, they've got, additional children. And so now they have to move for another reason because they need a bigger house.
Right.
Now we are seeing some of those folks putting $100,000 and $200,000 down when they buy that house because they've built so much equity. And it's fun to watch some of the YouTube videos and some of the the comments that you see on social media about there's real estate crash, prices are coming down. Well, not exactly. Now I think some areas of the country that's probably true.
Yeah.
But for the most part, we're seeing appreciation slow.
Yeah.
In other words, okay, well, maybe it went up 5% last year and it's only going up 1% this year.
Yeah.
Well, that's a decline in the appreciation rate, not a decline in the actual value. It sold for $100,000 last year. It's selling for $95,000 this year. Okay, that's different.
Yeah, and even if what I've seen from a lot of the articles that I've read and what some of the Realtor.com, Zillows of the world have put out is that they kind of expect a 1% decline in home prices across the board over next year, 2020, end of 2025, basically 12 months from now. This is August of 2025. So end of summer 2026, 1% less on the home price. But if you put that into perspective, average home price is around $400,000 in the United States. That means it's probably going to be, if these companies are correct and these analysts are correct, somewhere at the $396,000 range. So that's not exactly a crash, right? Everybody's thinking 2008, a $400,000 house is going to be worth $225,000 next year. That's not going to be the case. And that's what I think you have to frame that to all your buyers as you're going and working with these clients, as well as you have to frame your sellers. We're not in a market, and I tell this to every seller that I have, we're not in a market to set records right now. We're not going to get the highest price per square foot for the neighborhood that we've ever gotten in this current environment. There's too much inventory. There's too much consumer choice for the buyers, and we have to be realistic about our pricing. And, if you do that correctly, you tend to get on and off the market. But we're seeing listings that think that they can still garner those massive prices, linger on the market for 6 months or more, and then they end up selling for way less. There was one that I just closed on a couple of weeks ago that we got for $420,000, and the listing was originally $545,000.
Yeah,
and
we're seeing a lot of that.
Yeah, had they gone on the market appropriately priced, which probably would have been somewhere around $449,000, they probably could have gotten close to that, and they wouldn't have waited a year on the market. Instead, they got $420,000, a year after being in the game. So it's a very important thing.
Even if we do, let's say rates come down 5.5, 5.75, and now people are really starting to jump into the market.
Yeah.
We still don't have enough inventory. It's still low compared to the number of buyers that we have out there. And so, and a buyer, I was talking to a buyer the other day, and it was kind of funny because he even said it himself. He's like, well, buyers aren't committed to those houses. Like, they don't have to have that house.
Yeah.
Like they find one thing that's wrong in the inspection and they're out.
Yeah.
Because, they didn't have to move. You have a lot of them. They don't have to buy right now. They're perfectly comfortable where they are. All out of that going on, but the houses that are on the market are not as attractive.
Yeah.
The perfect house may not be on the market in their market. And
That's
so
true.
now they're taking, this is okay. I'll take it just because it's the only thing available on the block.
Yeah.
And then they find out the pool doesn't work or something. Like, okay, I'm out. I'm done. And they go buy something else, and they're settling. So,
and a lot of the new builders out there that are given these crazy interest rates and incentives and stuff like that. But I guess to round out the conversation, the question is, guys, before we finish up the conversation today, there's one thing that Mark and I noticed that's super concerning. Most of you that watch our videos are actually not subscribed to the channel.
Why would you want to miss out on great conversation like this?
If you're getting value out of the conversations that Mark and I are having, a subscribe to the channel helps us tremendously. We are on the road to 1,000 subscribers, and we're getting closer every day. And guess what? If you don't like us, you can always change your mind later. Now back to the content. We've seen mortgage rates drop. We believe that at least in some part is an anticipation of the rate cut in September. How much of that is built in, and then how much of that do you think it would actually change the average mortgage interest rates if they are to actually follow through and do the rate cut in September?
If we keep going like we're going, it's kind of going to be a nothing burger. I don't think it's going to be, like a massive drop in rates where all of a sudden we're at 5.5 or whatever. And we've always said, mortgage rates, they take the elevator up and the stairs down.
Yep.
They're taking the stairs down right now. And so if they're doing that in anticipation of the rate cut, and the rate cut happens, all right, we expected that.
Yeah.
If they don't cut rates, or God forbid they went up for some reason,
Hop back on the elevator.
oh my gosh, yeah, we're back in the elevator. And that's not good. And so, the biggest move we ever saw was, the day COVID hit.
Yeah.
And I don't think it'd be that drastic, but we would see a significant increase in rates. And maybe I should quantify that, because people say a significant, they think like 1%, 2%. No, we're talking 0.5% instead of a quarter. Over the last few weeks, we've seen rates come down 1/4 to 3/8%.
Yeah.
But that's taken several weeks of them. Okay, hey, you know what? It's still okay today. Yeah, we'll drop rates a little bit. Hey, it still looks good. We'll drop rates, and they're being cautious, but they're still doing it.
So speaking of that, we see, a 1/4 point, a 1/2 point, something like that. Let's say mortgage rates drop 1/4 point or a 1/2 point before the end of the year. You gave me a statistic a long time ago, and I can't remember it now. For every 1/4 point or a 1/2 point drop, there's X million new buyers that enter the market. Do you remember that?
I do remember that. I'm not sure it's as accurate as we thought it was.
Oh, is that right?
Honestly, but it is something like for every 1/2 point drop, there's another million buyers that come in the market.
Okay.
And that's probably where the number is, a 1/2 point. I think we used to say for every 1/4 point drop, we'd get 1 million buyers.
Yeah.
So I think that's you got to think, a couple of years ago, 7% was a normal thing.
Right.
8% was a normal thing, right? So we really, we've already come down, quite a bit. If you think about it, we've come down 2%.
Yeah.
Hasn't jump started the market, like we thought it would, but it's sort of like, okay, rates are here, and then okay, now they're here. Now if you drop it 2% overnight, now that could cause pandemonium, right? That people will be buying houses. There'd also be people at the Federal Reserve freaking out.
Yeah. Worrying about inflation and all that.
Yeah, now we're just worried about, everything's going to go the other way. So, there's a lot of talk about that. But also, another thing that's going on is the dissension from the ranks within the Federal Reserve.
Yeah, that's kind of the cracking of the egg, Humpty Dumpty sort of fallen off the wall there, because it seems like they were, at least to me, and I don't watch this as closely as you do, but it seemed like they were kind of a uniform front for the most part. And now it doesn't seem that way anymore.
No. And we're definitely telling buyers, okay, it's coming, make sure you're prepared. And so to that note, we like to look at people 3 to 6 months ahead of time if we can.
Yeah.
And so, if you're not buying till the end of the year or whatever, make sure your financial house is in order.
Right. So
you're ready.
Yeah.
And then you can take advantage of the best rates out there.
And I think that's a perfect place to leave it.